Hi, it's Chadwick Burks with People's Mortgage, and if you're watching this, you've reached the graduate level of the mortgage, bond, and stock market. I thank you so much for being here. I've made this video to try to explain to you what is going on in the mortgage market, stock market, and treasury market right now due to the coronavirus. The impacts are dramatic, so sit back. We're going to take about a 20-minute or so ride, but you're going to get information that very, very few other people in the country have, so I'll make it worthwhile for you. Put it in layman's terms, I promise. Okay? Here we go. The simplest way to put this is that the stock market and the treasury markets have moved negatively far too fast for mortgage rates to respond accordingly. So that's why the mortgage rates right now are not as low as they should be in comparison to stocks and T-bills. Now, there's not a direct relationship between mortgage bonds and the stock market indexes and T-bills, which are treasuries, but there is definitely a correlational relationship. And what that means is that almost always when the stock market or the treasury market significantly moves negative, mortgage bonds improve. And when mortgage bonds improve, that means interest rates for you, the consumer, go down. And the reason behind this is called a flight to quality. That's what analysts call it. And it's because investors, well, they're always looking for something to invest in. And if they believe that their stock or their treasury they currently hold, that investment is risky or it's going to return less money than they want, then they often transfer that investment to a mortgage bond, which is generally seen as a safer investment, or as an investment which may give them a higher return. So if you boil it down to the basics, supply and demand in mortgage bond investments in comparison to supply and demand in treasury note investments is what generally determines mortgage interest rates. Kind of a simplification, but that's pretty much what it is. If there is more demand for mortgage bonds, then this usually means that stock values are declining or treasuries aren't paying enough for an investor. So a high demand generally results in a lower rate of return on a bond or a treasury because the bond or the T-bill often sells for above face value. So to put that in simplest terms, when treasuries or stocks are paying an investor poorly in their eyes, or they're too risky, this increases demand for mortgage bonds. And the greater the demand for a mortgage bond, the lower the interest rate ends up being for the end consumer, for you. So that's why a declining treasury market or stock market generally produces lower mortgage rates for a consumer. But I said generally here for a reason. Right now, we are in the midst of what most analysts refer to as a black swan event. And a black swan event is something that is so unexpected or out of the ordinary that technical trading, which is what we follow day to day, those of us who analyze the markets, it takes a back seat. And what drives the bus at that point is fear, panic, rumors, and most importantly, daily events, daily news. And the last true black swan event we had was shortly after 9/11. When the economy was uncertain, travel was uncertain, safety was uncertain. So when you have these black swan times, all the markets are extremely volatile because you have normal folks that are trying not to lose the wealth they've accumulated so far in their 401k retirement accounts or their personal trading accounts. And then you combine that with multi-million and billion-dollar firms that are just endeavoring to stay in business and to not take huge losses, and they also still want to generate some profit, then you throw into the mix a dramatic increase in day traders that are just trying to cash in regardless of what direction the market moves. And when you have extreme volatility like this, it makes it very, very difficult to secure an interest rate in real time because the large mortgage lenders are trying to constantly adjust their rate sheets often as possible. multiple times during the same day in some cases. So I'm going to show you a behind the scenes look, an example of the extreme volatility that's going on right now. So here's a chart for mortgage-backed securities. This is for the bond trading chart for mortgages, okay? Two things you need to know about these charts I'm going to show you. The first is that on any line that is green, and these are actually called candles, right? Anyone that's green, you read it from the top, okay? Any line that's red, you read it from the bottom. These are called Japanese candlestick charts. So any of you out there that are realtors, or if you're a mortgage customer with someone else and your lender hasn't had a discussion with you about Japanese candlesticks, you're with the wrong lending partner, is all I can tell you. Because this is high level stuff, but it's really critical if you want to know what the heck is going on. Now, the second thing you need to know is that on these charts like this, the lower the candlestick is, the higher mortgage rates were at that time. Okay? So think about that. Wherever you see the lower trend on these charts, that's going to indicate higher rates because there's an inverse relationship like we talked about before. So this chart here is basically a 1 year chart of mortgage-backed securities. And as you see, this will show the demand for bonds in the secondary trading market. So look here to the left and you'll see that we had probably the highest rates we've had in quite a while. And this was back in April of 2019. Since then, you see the trend and rates and pricing started slowly improving. But you'll also notice that there's not a lot of straight lines, right? There's obviously ups and downs day to day, but you're not seeing straight, jagged rises to the top or down to the bottom. But you see the overall trend is improving. Now let's take a look at a different chart. This is a 6-month chart of mortgage-backed securities. And I want you to see here how small the normal moves are, okay? See how small these moves are. Look how short the candlesticks are. That's how the mortgage market typically moves. They typically move in a pretty tight window of a few basis points a day. And basis points are how mortgage securities are traded. Just consider them like fractions of percentage points. So normally we have a flat market or 3 or 4 or 5 point moves here and there, just not really enough to do much. Anytime we see something like a 20 basis point move or more in a day, that's considered very significant. Right now, we're seeing moves that are hundreds of basis points in a day. Not 3 or 4, not 20, hundreds of basis points in a day. Okay? So now that you got that, I'm going to show you a more current chart. This chart is from the morning of Friday, March 20th. And as I mentioned earlier, part of the challenge for mortgage lenders right now is to provide rates that are in line with everything else that's going on in the market. Remember when I said that they are having to constantly adjust their rate sheets throughout the day, investors, which by investors I mean mortgage investors lending the money. I want you to look at this. Look at these huge candlesticks here. And look at the little tails on either side. They're called sticks or tails, however you want to. Some people call them horns if they're on the top, sticks on the bottom, or I mean tails on the bottom, but either way, tomato, tomato. So whenever you see a horn or a tail or a stick, if you want to call it that, on one of the bars, that means that at one point during the day, the market was at that level. So you see the highest the market went up that day, and then you see where it ended up closing. You see the highest it went here, and then where it ended up closing. These are more than 100 basis point moves, both to the positive and the negative. And when you look at the tails on these candles, it's even more telling. I mean, look at the next to last candle over here. The spread on this is enormous. It moved back and forth during the day in about a 260 basis point spread. Now remember, a significant move in mortgage bonds is around 20 basis points, right? So this trade went positive and negative during one trading day in a 260 point range before closing just slightly positive over where it closed the day before. So lenders were likely reducing rates and then raising rates, reducing rates, raising rates during the day again and again and again. And in fact, on this day in particular, it was nearly impossible to lock an interest rate because lenders were adjusting the rate so often. And while the rates are being adjusted, you're unable to lock a loan. Everything's frozen because it takes time to make the adjustments in the lender and investors' computers and whatnot, and they can't take orders till those adjustments are made. So with this much volatility, on what side of caution do you think lenders are going to err? You think they're going to err towards the rate being a little higher than it should be or a little lower than it should be? Well, bingo, of course, it's going to be higher. I mean, that's pretty obvious. Okay, I'm not going to dig super deep into this because this video would go on for hours, but you might find it interesting or scary, depending on how you look at it, that a rate lock, when you go to lock your interest rate, that's just a binding promise between you and the lender. It protects you, but it doesn't really protect the lender. There's basically no such thing as a lender locking in a mortgage rate with an investor. And an investor, we're talking about the high-level guys, Fannie Mae, Freddie Mac, Ginnie Mae, etc. So the lender has to take the rate that the investor gives them when they deliver the completed loan to the investor on the secondary market and the mortgage is completely finished. And what you don't realize is just because you sign your papers and you're finished, the mortgage company that gives you that loan probably doesn't deliver that loan to the secondary market, to the investor. It could be 2, 3, 4 days, could be 2 weeks, depending on different circumstances. Okay? So the lender is going to lock the rate with you and provide you, that interest rate as long as you close before the rate expires. The lender's going to honor that rate for you. And for you, the rate is locked. That's great. But when the lender sells or transfers your loan to the investor, that rate that you closed on might not be available to the lender without a cost, a significant cost. So what the lender does behind the scenes, which nobody talks about except me, because I always give you the straight scoop, right? It's called hedging. And what they basically do is they take out insurance policies, and I'll go insurance policies just for lack of a better word, and to protect themselves from the rate skyrocketing before they can deliver your loan to the secondary market. The mortgage market would have an incredibly hard time functioning and existing without hedging, so it's not a bad thing. But I do want you to imagine what your mortgage lender is going through right now, trying to hedge loans so they can get you the best possible rate you can get during this time when the market's doing this all day. It's incredibly hard for both the lenders and the investors to deliver a completed loan consistently with this much volatility, okay? So where are we now, right? For a brief period of time on March 9th, it looked like rates were finally where they needed to be for a very, very large number of people to refinance. As you know, rates have been low for several years now. They've gone up and down a bit, but they've been low for several years now. And a lot of people are already locked in on a low rate. And you might say, well, my rate's not low enough. It's in the high 3s or the mid 4s or whatever. But you have to realize that, rates used to be 18, 20, 24%. And not that long ago, a good rate was in the mid 6s, okay? Like a really good rate. So slow your roll on that. Do a little research on where interest rates were. People have gotten a little spoiled on rates right now. And it's not a bad thing. I'm a full supporter. I want to get you the lowest rate you can possibly get. But you have to look at this in a realistic and historical perspective. So March 9th, we hit a level to where a whole lot of people like, okay, now this is so low. It's getting near the lowest ever that it might make sense for me to refinance my loan. So March 9th was the first day there was a huge volatile spread. Rates had gotten better, but they had gotten better multiple days in a row, but they weren't huge increases. They were above average, but they weren't drastic, right? March 9th was the first day that there was just a huge daily rate swing and spread. But the rates did not lower on the rate sheet as expected, as they should have. So a lot of lenders, a lot of loan officers out there, they tried to lock loans and they were unsuccessful. They couldn't do it because the rate sheets were fluctuating nonstop from the investors. And then there were other loan officers who held off on locking because they have followed the market and they felt the rate should be much lower considering the far path that bonds had traveled in comparison to the stock market and treasury market. That like with this big of a spread, the rate should be way lower than what you're offering me right now. So instead of the rates improving on the 10th, 11th, and 12th of March, they got worse dramatically. They dramatically went brrr, which means higher, okay? And this was due to a lot of factors. But the easiest way to summarize is just to say because the stock market had fallen so fast that mortgages couldn't catch up. They tried to catch up, but the stock market fell so quickly that a lot of investors received margin calls. And what a margin is you can buy stock when the market's good or bad if you're betting it's going to go negative. If you're one of those guys that doesn't bets the no pass line and craps, then God bless you. But anyway, a margin call is when your money's called due. So you can buy stock on margin, which is basically borrowing money to buy more stock, right? Before that borrowed money is due, you plan on selling the stock, making a profit, so you have no problem, right? Well, the stock market tanked so fast that these margins were called in, which means that the investor that had something bought on margin, they're forced to make that borrowed money whole immediately. A lot of people that are buying on margin don't just have boatloads of cash sitting around. That's why they're buying on margin. So their only choice to meet that margin call on the declining stock investment was to sell off the safe investments they had. And their safe investments, like we talked about, were mortgage bonds and treasuries. So all these margin calls came in. Everyone said, well, I got to pay my margin call. So they sold off their treasuries. They sold off their mortgage bonds. And this flooded the market with mortgage bonds for sale. And like we talked about earlier in the video, mortgage rates are based on supply and demand. So if the mortgage market is flooded with people selling, wanting to sell mortgage bonds, the demand, obviously, supply is way bigger. Way, way, way bigger than demand. So what happens? Well, mortgage rates went up so that bond investors could make more profit by buying the bonds. They're going to say, man, there's so many bonds out here of mortgages. I'm not going to buy them unless you make it worth my while. You pay me more and I'll buy this bond. And the only way they can pay you more to buy the bond is if they raise interest rates because someone has to pay for it. So that's what happened. And this continued for several days till these margin calls were met. And so then it started to kind of turn around in favor of mortgages as all these bonds were kind of gobbled up by investors. Now, I'm not going to give you a blow-by-blow of the last 10, 11, 12 days because that'll take pretty much another hour. But I will tell you that we've seen 10 days, we'll say 12 days at this point straight, of never heard of volatility in the markets, both positive and negative. The Federal Reserve has done multiple things to try to salvage the economy. I'm sure you've seen it on the news. You probably didn't understand it all, but you saw it on the news. And they don't want you to understand it all. So it's nothing on you. They speak in gibberish on purpose. But people like me, that's our job to understand it, right? So they've done several things, the Federal Reserve, to bolster mortgage bonds and treasuries and the stock market all at the same time, which, as you can imagine, is incredibly difficult. And they've done virtually a version of quantitative easing, which is unlimited. And I'm not going to get into that, what quantitative easing is. It'll take forever. Let's just say the short version of that is, if you are an investor, investment company, someone, a bank who has a large number of bonds and you can't sell them, then the government's going to buy them from you to give you some liquidity. That's like the quickest, very undersimplified, but anyway. So their action of doing this, which is unlimited quantitative easing, it's never been done before. Quantitative easing's been done, but this is unlimited. There's no limits on it, and that's a great thing, but it's a little bit scary at the same time. But that's a different cup of tea. But the action helped quite a bit. And yesterday on March 23rd and today on the 24th, mortgage bonds were up roughly 90 basis points each day, which up in a good way, which means helping rates. At one point, they were up over 168 basis points from the previous day's close. Now, of course, it only closed up 90, but remember that big spread? Imagine you're up to 168 and like, back to 90. 90 is still good, but 168 would have been way better. But 2 days, 90 points a day, that's amazing. So should bonds hold out at this level or better, and they sustain those gains through tomorrow, this should likely put us at levels close to or exceeding where we were on March 9th, when no one was prepared for this at all. Now, yeah, there's still tons of issues right now, but at least the market has seen it for a couple of weeks, so should be a little more prepared for it. Remember, March 9th is when everybody wanted to lock, and the market pricing didn't reflect the move. A lot of people did lock, and they just took the worst rates and didn't realize it. So for those of you who didn't, that's a good thing. But some people are saving enough money on their debts, and they're paying off credit cards, and they're still, their rates maybe 0.75% higher than it should be, but who cares? they're in the fours instead of paying 18-19% on a credit card, so it works out great. But there's a lot of factors that are going to dictate the rates in addition to this bond trading and the stimulus. But I mean, we're definitely in a very positive sign what's happened the last couple of days. Tomorrow, the government is expected to announce a stimulus package, and that should lead to huge volatility in all three markets. Hopefully, it's going to be positive for bonds. Theoretically, it should be. But remember, we're in black swan times here, so sometimes they throw the baby out with the bathwater. The mortgage industry is still dealing with hurdles as a whole. I'm not going to lie to you. The whole industry is in damage control right now, including manpower issues, capacity. Think about it. A lot of offices have been forced to close. They've been under quarantine. Their employees are transferred to work at home. And those of you who work at home know that working at home, you're not as productive, period. Even if you try to be as productive, you still don't have the equipment you need, the computers you need, everything. So that's causing some issues. Appraisers are flooded with appraisal orders right now. They're trying to deal with the volume they've never even seen or thought of before, and they're trying to turn them as fast as they can. But a lot of times the appraisal turn times are delayed. We're lucky, for those of us who live in Arizona that are watching this video, that we have a very active market, so we have a large number of appraisers anyway. But some of the smaller states that are affected by this, the turn times are just blow your mind right now, okay? That's the best way I can say it. Treasury Secretary Mnuchin also projected a possible unemployment rate of around 20% or more. Of course, that made the market go haywire after he said that. It's settled down a bit now, but mortgage bonds now are factoring that statement into their risk pricing. So along with everything else, part of the mortgage rate being dictated is, well, if we give you a mortgage, are you going to be able to pay it back? Are you going to have a job in this many months? Are you going to make your payments or not? That wasn't really a factor before, but after our good buddy in the Treasury made that comment, which can't fault him, it's true, could be true, but certainly didn't help the mortgage market. So, of course, once some of these loans that got put in the pipeline back in February and March, and there were an insane number of them, once those start closing, which they should have started closing by now, then that's going to free things up a lot more. The appraisers will catch up eventually, but it's going to take a little bit of time. But patience, I'm telling you, hear me now and believe me later, patience will very, very likely be rewarded. Me personally, I'm advising all of my mortgage customers to get their loan applications submitted now, if they haven't already, and provide their necessary paperwork now. So that means the loan is already in the system. It's already in a position to take advantage of a rate lock the minute that target rate becomes available. And it's really starting to look like that rate is going to become available sooner rather than later. Now, when that rate does hit, we all get our money from the same places as mortgage lenders, pretty much. And when that rate does hit, there's going to be a rush, a huge rush. And that rush is going to happen with new applications and new appraisal orders again. And then everything's going to get pushed further out. There's going to be uncertainty and there's going to be delays again. But here's the secret why you do it now. Because if your loan is already disclosed and it's already in process, the ball's already rolling, it's in a different department, a different level than the person who does the applications and starts it out and da-da-da. It's moved on to a higher plane. And in that higher plane, you can lock the loan, bam, with just a few clicks. Locking is going to be way easier now, as I mentioned, because we're past that freak out from March 9th. So your loans aren't in process because you took Chad's advice and submitted already, turned your paperwork. Now we can lock it, bam, locked. You're protected. Appraisal order. Okay, you're already in process. Click, click. We just ordered the appraisal. Now you're ahead of all those people that have to sign their disclosures still, get their intent to proceed back, get some base level of paperwork and documentation before they can order appraisers. So that's how you can beat that rush, right? Before the uncertainty kicks in again. And I'm telling you, what you see on your loan disclosures now, because we're not locking the rate yet, we're watching the market. So what you see on your disclosures now for underwriting purposes might be very, very different from what you see when the rate is locked. And I mean that very, very different in a good way. And finally, I'm also advising my customers not to be greedy. I mean, no one can say with certainty where the bottom of this market's going to be. We are at now or very near the lowest rates that have ever existed in the history of mortgage lending. You hear that on commercials all year round for 3 or 4 years because some jackasses don't tell you the truth, just rerun the same commercials. But now is the only time ever their commercials are accurate. We literally are now at the lowest rates in history, okay? So even if the absolute bottom of the market, which none of us know for sure, even if someone hits the absolute bottom of the market and you miss that bottom by 1/8% or 1/4%, a customer misses that, they're still going to have an interest rate that is likely never going to be available again in their entire lifetime. So anytime you're looking at financing, you always have to look at risk versus reward. So you have the risk of trying to wait too long to get another 1/4% in rate or 1/8% in rate and then missing the chance to refi altogether. That risk vastly outweighs the possible reward of saving something like $10 a month in my interest payment, right? And then think about this, which backs you up even more. If rates do end up going significantly lower than the current rate you refinance at now, well, the customer can always refi again in the future, do it with little cost or no cost, and it's going to improve the situation even further and they've saved the money during the period they've waited for that absolute bottom to hit instead of sitting there at a much higher rate to begin with. So, I mean, I hope you found this information helpful. I know this video is a little long, especially in the era we live in where everybody wants chop, 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 chop. But I'm telling you, I did you a huge favor. I took like 8 hours of stuff and squished it down to this. And in fact, I'm going to give you some more updates in the coming days, explaining things even further, because there's some things that happened today and yesterday which I didn't dig really deep into, but you might find useful. But I tried to put it in layman's terms for you instead of financial mumbo jumbo to help you as much as I can. For those of you who have asked, and I've been getting a lot of emails about advice and such for this, I'll tell you that my personal customers are already taken care of. So I watch the markets all day, every day. I communicate to them updates and strategies, what we're doing. If you're watching this video, you shouldn't have stole it, but I know things get around. It's okay. I made this to share the wealth, the knowledge, and love for everyone. Seriously, I was just joking about that. But if you're not a customer of mine, but you're thinking about refinancing or buying a home, then shoot me an email or a text or call me. Seriously, my contact information is at the end of this video. And sure, I want your business. Sure, I want to make money. I want to feed my family. But more importantly, I really honestly care to get you the best deal you can get and to not be taken advantage of during this time. I get calls every day about someone that is giving me information that another loan officer gave them that is simply not true. It's not true. It's not accurate. And I'll say a third of the time, it's just because that loan officer is not educated or experienced enough to know the right answer. But unfortunately, 2/3 of the time, they're just flat out giving misinformation because they want to secure a deal. Like in the old sales trainings they have, they teach you that get them in the door and then go from there. I am adamantly against that, adamantly opposed to that. This is my personal opinion from people calling me. Yeah, I'm not stating it's an official opinion of anyone else, but my opinion from people calling me, I've heard stories that'll break your heart for people getting taken advantage of. And yeah, I can help people, make them feel good, get them a good deal, and protect them, and still feed my family at the same time. And that's what I want to do. So if you're thinking about it, like I said, my info is at the end of the video. Please contact me. Even if you just have questions, I'm happy to ask you the questions. Because I guarantee you, the overwhelming majority of mortgage loan officers out there do not understand the information that I've just given you. They don't know about it. And even if they do know about it, they don't understand it. And even that tiny, tiny, tiny percentage that does understand it, they're not going to take the time, and they haven't taken the time to write and record a video like this to give information to the public. And I'm telling you, it takes a lot of time to do this, to get all the facts and figures and charts, and just the editing is a pain in the butt. But it's important, and that's why I do it. Finally, if you're a realtor, I hope this information has been helpful for you to understand what's going on in the market right now, so you can guide your clients and they can have a smoother transaction, happier transaction. They don't have that uncertainty. They don't have those questions. Because I know as a realtor, if you're doing a purchase, things are even more stressful for you because you have closing dates and closing timelines. And nothing's worse than getting that customer who goes, well, I heard rates are going to go down, so we need to put this closing off or cancel this closing. That's the last thing in the world you want, and there's reasons why. So I hope this information has helped you. I'm always here to help you if you're a realtor. I'm here to give you financial information so you can focus on what you're good at, which is housing, and I'll take care of the financial aspect with your clients, okay? So give you a smoother, happier experience for everyone. Penny whistles and moon pies. So I'd love to be your referral partner. I'd love to help you keep your customers educated and take care of them. So if you're a realtor, shoot me a quick email. I'll tell you all the tools that I have that will make your job easier and help you make money without drowning in this sea of madness called COVID-19. Well, I mean, I hope you guys have a great day or night, depending on when you're watching this. Please do like, forward, and share this video because I do want the information to go out to everyone. That's the whole point I made this, is to tell people Everything's fine. Don't panic. We're going to get there. We're going to get there a lot sooner than you think, but you have to be with the right person who knows what they're doing, or you're going to lose. And it is possible to navigate this, and we're going to do it. So keep your chin up. Take care. Stay safe out there. And as Bill and Ted would say, be excellent to each other.